Welcome back to our channel. Today's video is about the tumultuous tale of StoryBuilt Homes. The real estate developer whose account reads more like a Greek tragedy than a business plan. This company grew so fast that they forgot to nail down the basics, like, keeping track of their finances. One must wonder if they were building homes or just elaborate sandcastles. Stay with us as we unpack how their house of cards came crashing down in a pile of legal troubles, after millions of dollars were mysteriously squandered away seemingly overnight. This is Real Estate Rundown. Here we go. StoryBuilt Homes, based in Austin, Texas, once a leader of innovation and rapid expansion in the real estate development sector, suddenly experienced a precipitous decline that has captivated public attention and drawn scrutiny from the highest levels of Texas politics and finance. The following report traces the rise and dramatic fall of StoryBuilt, detailing a complex web of legal and financial challenges that have emerged in the wake of its collapse. Originally founded with the vision to transform Austin through sustainable and innovative urban housing solutions, StoryBuilt rapidly became a prominent name in real estate development. The company specialized in developing residential properties and had a mission to merge property technology advancements with traditional real estate models, setting ambitious goals to become a PropTech giant. By 2022, a year before its fall into receivership, StoryBuilt had completed over 50 residential developments and was involved in selling or leasing more than 1,500 homes. Its success was marked by swift growth and the company's ability to tap into promising urban markets. However, the facade of success began to crumble in August 2023 when StoryBuilt entered receivership. The trigger was a severe liquidity crisis. The company could no longer sustain its operational costs or manage its debt repayments. This development was shocking to many who had viewed StoryBuilt as a robust and thriving enterprise. A Los Angeles-based receiver was appointed to take charge of the company's assets, tasked with stabilizing the situation and salvaging whatever value remained in the beleaguered company's portfolio. The receiver, upon a detailed review of the company's financials, uncovered what appeared to be significant mismanagement. Accusations centered around the misuse of funds. Money allocated for specific development projects was allegedly diverted to cover corporate overhead and other unrelated expenses. This prompted a forensic analysis of StoryBuilt's books, which revealed a complex corporate structure that obscured the full picture of its holdings and financial dealings. The receiver estimated that the total value of the company's assets, comprising of 28 developments and development sites at various stages of completion, to be around $2 billion. However, the actual recovery was clouded by the fact that many of these assets were undeveloped sites, complicating the valuation and potential sale processes.
StoryBuilt is a design-build developer that has gone into receivership as of last week, and I'm going to go look and see how many projects they have under construction. But this one out in East Austin, it's a big hole. In the ground. Had a crane up. Crane is now down. So clearly they've stopped work on this project, and who knows how many. So, my word to the wise, be careful who you invest in. They had billions in investments, and that quickly. You can go from great returns to losing all of your capital and all the projects being underwater, over, defunct, etc.
The situation was further complicated by the involvement of high-profile figures in Texas politics. Tom Craddock, former Texas House Speaker, along with his children, Tommy and Christy Craddock, the latter serving as the chair of the Texas Railroad Commission, were deeply entangled in the aftermath. They had invested approximately $4 million into one of StoryBuilt's projects in Dallas, known as Project Goose.
This is the StoryBuilt Homes project, known to them as Project Goose. They borrowed a lot of money to acquire this land and knock down the old office building that was here and get this development started. But you can see there's not a lot going on out here.
The Cradocks had arranged for Stillwater Capital, another real estate firm based in Dallas, to potentially purchase the project for about $10 million, contingent on rolling over their initial investment into the new deal. However, the receivership and subsequent allegations of fund misallocation promptly destabilized that proposed deal. The receiver's decision to pool all proceeds from asset sales and delay the disbursements meant that the Cradocks and Stillwater could not immediately access their funds to reinvest, throwing the arrangement into jeopardy. Stillwater then considered reducing their offer by $2 million if immediate access to the funds was not possible. But wait, just a minute. Partners Group, a Swiss-based asset management giant with $142 billion in managed assets, was StoryBuilt's largest financial partner and had objections to this idea. They were involved in 177 joint ventures with StoryBuilt and were accusing the receiver of failing to consult them before marketing the assets for sale, which created some distress among investors and potential buyers. They insisted on their right to approve any sales involving their joint ventures. Amid these high-stakes disputes, another mysterious player emerged. GET Marketing LLC, based out of Houston. This company had apparently initiated the receivership request and owned a significant portion of StoryBuilt shares. Oddly though, GET Marketing has little online presence, which is unusual for a company of its nature. Associated with GET Marketing was a person named Trey Cook, whose exact role and interests in the receivership proceedings remains unclear. As of now, the receivership is still managing through the asset sale process, attempting to stabilize StoryBuilt's financial situation while navigating the complex legal challenges presented by the various stakeholders. The receiver hired Onyx Asset Advisors and A&G Realty Advisors to market all of StoryBuilt's assets, with the possibility of selling the portfolio piecemeal if a single buyer for the entire portfolio does not emerge.
Look at this neighborhood. It's completely abandoned right now. Sales trailers closed. These houses are like falling apart. I mean, the inside of that house I just walked in and it's all the wood's been damaged, everything. You got to check this out. This is what's wild. We tried to walk in this home. I did not break down that door. It was like that. But check out. Check out all of that. Isn't that wild? It's like abandoned neighborhood in Austin. Completely abandoned right now. The developer abandoned it. They didn't finish any of the work. Look at this. This is wild. And look, they got foundations everywhere.
StoryBuilt's case is a cautionary tale about rapid expansion without sufficient financial oversight and the complexities that can arise when a booming business suddenly falters. As legal proceedings continue and more details are likely to surface, the real estate community and investors are keenly watching. How could one of Austin's most promising developers unravel so quickly and leave such an aftermath of tangled legal and financial disputes? The depth of StoryBuilt's troubles became apparent as the receiver continued to peel back the layers of financial mismanagement and potential fraud that had occurred under the previous management's watch. It was revealed that the misallocation of funds was not just limited to a few projects, but was rather systemic, affecting nearly every aspect of the company's operations. The receiver's report suggested that management's reckless financial practices included diverting funds from designated projects and also engaging in speculative investments without proper risk assessment or oversight. This reckless financial behavior was exacerbated by a lack of transparency and accountability, which had enabled the mismanagement to go undetected for years. The fallout affected not only the investors and financial institutions involved, but also the hundreds of employees and contractors who depended on StoryBuilt for their livelihoods. The sudden collapse of the company left many out of work and numerous projects incomplete, leading to broader economic repercussions in the communities where StoryBuilt had been active. The legal battles also highlighted the challenges of dealing with a receivership in the complex world of real estate development. Each project involved multiple stakeholders with conflicting interests, including developers, investors, creditors, and government agencies. Negotiating these interests of all parties requires a delicate balance. This is to ensure that the assets are sold at a fair value while also addressing the claims and concerns of all the stakeholders that are involved. As the case continues to unfold, it serves as a stark reminder of the risks inherent in the real estate development sector, especially when aggressive growth is pursued at the expense of sound financial management and ethical business practices. It also underscores the importance of regulatory oversight and due diligence in protecting the interests of investors, employees, and the community at large. The resolution of the StoryBuilt saga will likely take years, with ongoing litigation and asset sales continuing to reveal a complex web of transactions that define the company's troubled past. The outcomes of these proceedings will not only determine the financial recovery for those impacted, but will also set precedents for how similar cases are handled in the future, potentially leading to stricter regulations and oversight in the real estate development industry. What are your thoughts? Do you think these guys were just in over their heads, or is this a case of premeditated fraud? We appreciate your comments below and hope that you will like and subscribe to our channel for more videos like this one. This is Real Estate Rundown. Be kind to others.